Welcome back, everyone. Today we're diving into another fascinating episode of Investors Podcast, broadcasting from Bel Air, Maryland. I'm your host, Preston Pish, and as always, joining me from Denmark is my co-host, Stig Brodersen. In this episode, we're going to explore a book that we've mentioned many times before, one that has had a huge influence on investors around the world. The book is The Intelligent Investor by Benjamin Graham. To give those unfamiliar with him a bit of context, Benjamin Graham is considered the father of value investing. He wrote two highly influential books, Security Analysis and The Intelligent Investor. Graham taught at Columbia University starting in 1928, and one of his most famous students was Warren Buffett. Buffett has openly said that nearly everything he knows about investing came from Graham's teachings, considering Buffett one of the richest and most successful investors ever. Bases his entire investment philosophy on Graham's ideas. It makes sense why this book is so important to Graham's first major work, Security Analysis, came out in 1934 during the Great Depression, and we've already covered it in a past episode. That book is targeted more toward professional analysts, but The Intelligent Investor is written for everyday investors who want to learn how to make smarter, safer decisions with their money. In today's discussion, we're focusing on the key lessons in this book. Stig actually prepared today's agenda. Here's the structure we'll follow. First, we'll talk about chapters 1 through 7, then we'll give special attention to chapter 8, because it contains one of the most important concepts in all of investing. After that, we'll move through chapters 9 to 19, and finally, we'll dedicate the last section to chapter 20, which introduces the powerful idea of margin of safety. Let's begin with chapters 1 to 7. The book opens with a critical concept: understanding the difference between an investor and a speculator. This distinction shapes the entire book. Graham explains that an investor is someone who aims for reasonable returns, nothing extreme or unrealistic, and prioritizes protecting their original investment. He doesn't put an exact number on what reasonable returns means, but he makes it clear that chasing massive, quick gains falls into speculation, not investing. If someone is trying to make 40% or 50% in a year, that person is speculating. An investor, according to Graham, seeks returns that make sense based on the company's long-term performance and stability. For example, if you bought stock in a huge, stable company like Apple, whose revenue and net income have remained fairly steady over the years, and you don't see any major risks coming soon, that is investing. It's based on predictable performance. But if you buy stock in a company whose financial results swing wildly from quarter to quarter, that starts drifting into speculation because the risks are far less predictable. Graham breaks it down into two crucial points. An investor aims for a fair, not excessive, return. An investor never puts their principal at serious risk. He summarizes it beautifully. Investment is an operation that, upon thorough analysis, promises safety of principal and an adequate return. If what you're doing doesn't meet these two conditions, then you're speculating even if you don't realize it. As soon as your decision becomes based on feelings like "I think this is going to go up," instead of solid evidence and analysis, you've left the world of investing. Stig makes a great point here. True investing is actually very boring. It's not about excitement or constant action. Real investors don't buy and sell frequently. They buy great businesses and hold them for 10, 20, maybe even 30 years. If you want thrills and fast outcomes, investing may not be the right field for you. One of the key parts in these chapters is Graham's explanation of defensive versus enterprising or active aggressive investors. A defensive investor prefers low effort, low stress, and lower risk. They simply want steady, reliable results. Today, Graham would probably recommend simple, diversified value ETFs for defensive investors. On the other hand, enterprising investors seek higher returns by putting in more time, effort, and research. But Graham warns that many active investors actually underperform because while they work hard, everyone else in the market is also working hard with the same information. Then there's the idea of popular versus unpopular stocks. Graham found decades before computers that stocks with low price-to-earnings P/E ratios, which were usually unpopular, often outperformed the market over time. This was groundbreaking research in 1949. He also emphasizes comparing price and value. A high-quality company isn't always worth buying if the price is too high. Conversely, a lower-quality company might be worth buying if the price is low enough to compensate for the risk. Value comes from comparing what you pay with what you get. Next, Graham discusses inflation and corporate earnings. He believed that stocks provide partial protection against inflation, unlike bonds, which are fully exposed to inflation risk. Warren Buffett later expanded on this idea, explaining that companies with intangible assets like strong brands handle inflation better because they don't need to constantly reinvest in expensive physical resources. At this point, we arrive at one of the most important chapters in the book, Chapter 8, which Buffett has called the single greatest chapter ever written on investing. This chapter introduces the famous character, Mr. Market. Graham describes Mr. Market as an emotional business partner who shows up every day offering to buy your shares or sell you his. Some days he's overly excited and offers high prices. Other days, he's depressed and offers very low prices. Your job as an intelligent investor is simple. Ignore Mr. Market's emotions and only act when he offers you a great deal. You do not have to accept his daily offers. You evaluate your own estimate of a company's value and make decisions based on that, not on his mood swings. This concept teaches you to detach emotionally from market fluctuations. Prices move constantly, but value moves slowly. Buffett said that if you truly internalize Chapter 8 and Chapter 20, you will become a successful investor. Following the powerful lesson of Mr. Market, many investors often ask whether timing the market is possible. People hear that you should avoid timing the market, yet at the same time, they hear about taking advantage of market swings. Is this a contradiction? Not at all. The point Graham makes is that you are not trying to predict what the market will do tomorrow, next week, or next month. Instead, you are simply comparing available opportunities. Preston explains that he constantly looks at the returns offered by different investment classes: bonds, stocks, commodities, currencies, and evaluates which one provides the most attractive return relative to its risk. For example, if the 10-year US Treasury bond yields around 1.7%, while the US stock market yields roughly 4% based on its earnings, the difference in return might seem meaningful. But the stock market comes with higher risk, especially when prices seem elevated due to central bank intervention or other macroeconomic forces. That means a 2 to 3% spread in yield may or may not be enough compensation for the extra risk. This is not market timing. This is rational decision-making based on comparing value and alternatives. You are simply choosing the best option available right now based on yield, risk, and long-term expectations. That's very different from guessing short-term moves. As Stig emphasizes, when you buy a stock, your decision should come down to two simple questions. What is its value? What is its price? If the price is far below the value, you buy. If the price is far above the value, you avoid it. It is not about predicting where prices go next. It is about knowing what something is worth. This leads directly into chapters 9 through 19, which focus heavily on evaluating companies and determining their worth, one of the most important tools here is understanding discount rates and normalized earnings. Preston explains that much of security analysis focused on bonds and fixed income, whereas the intelligent investor focuses more on stocks. Graham doesn't provide a specific formula for calculating intrinsic value, but he does stress understanding discount rates and comparing earnings to price. To understand intrinsic value, you must understand free cash flow, the actual cash left over after a business pays for all its expenses, investments, and taxes. This free cash is what truly matters because it represents money the company can either reinvest or distribute to shareholders. Imagine a company selling a product for $1. That $1 is revenue, its top-line figure, after expenses and taxes. Suppose it keeps 10 cents. That 10 cents is its profit margin. If we adjust for non-cash items like depreciation and capital expenditures, we eventually find the free cash flow, which represents the company's real economic earnings. If a company consistently grows free cash flow, say $800,000 one year, $900,000 the next, and $1 million after that, then you can begin to reasonably estimate future cash flows. This predictability is the foundation of true investing. Asterisk on the other hand. If a company has highly unpredictable earnings, big profits one year and big losses the next, then its value becomes much harder to estimate. Such companies fall more into the speculative category. Asterisk once you estimate future cash flows, you must determine what they are worth today. This requires a discount rate. The discount rate reflects opportunity cost, inflation, and risk. Warren Buffett typically uses the 10-year Treasury yield as a starting point because it represents a risk-free benchmark. But Preston offers a compelling argument. Using the Treasury yield, especially when it is extremely low, can artificially inflate intrinsic value estimates. For example, if interest rates are close to zero, discounting at such a low rate makes every company look far more valuable than it actually is. Instead, Preston prefers using the current earnings yield of the S&P 500 around 4% as the discount rate. This method compares equities to equities, rather than comparing a volatile stock to a stable government bond. More importantly, it creates a more realistic and conservative estimate. Stig agrees that when interest rates are extremely low, using the 10-year Treasury as your discount rate becomes misleading. Low rates don't eliminate risk, they simply distort valuations. Using the S&P 500's yield as a discount rate forces you to ask, is this individual stock likely to outperform the market enough to justify choosing it over a diversified index? If the answer is no, then there's no reason to take the extra risk. This discussion highlights why intrinsic value calculations are challenging to explain purely through audio. Charts, graphs, formulas, and visual tools make the topic much clearer, which is why Preston and Stig encourage viewers to explore their online calculators and video tutorials. Now we move to one of the book's most famous lessons, Chapter 20. The Principle of Margin of Safety. Graham says this concept is the cornerstone of intelligent investing. Warren Buffett illustrated it with a simple analogy. Imagine you're designing a bridge that must support a 10,000-pound truck. Would you build the bridge to handle exactly 10,000 pounds? Of course not. You'd build it to withstand maybe 15,000 pounds. That extra capacity is your margin of safety. Investing works the same way. If a company's intrinsic value is calculated at a level that gives you only a small advantage over alternatives like the S&P 500 or Treasury bonds, then you have almost no cushion. Your assumptions might be wrong, the company's future might change, or economic conditions might shift. The margin of safety protects you from being wiped out by small errors. So every intelligent investor must ask, how much extra expected return is enough to justify the risk I'm taking? If the S&P 500 offers a 4% return and a single stock offers a 6% return, is that extra 2% enough? For some people, yes. For others, not nearly enough. Stig adds that margin of safety is extremely easy to grasp if you already understand value versus price. Once you accept the idea that markets fluctuate more wildly than underlying value, the importance of buying with a margin of safety becomes obvious. However, Stig also points out something interesting. Graham didn't talk much about competitive advantage or moats the way Buffett does. Graham was more focused on numbers, assets, earnings, balance sheets, while Buffett added qualitative analysis over time, strong brands, patents, loyal customers. These are things Graham didn't emphasize, but Buffett considers essential in modern investing. As we near the end of the episode, Preston shifts from analyzing the book to discussing how he and Stig try to help listeners build income streams and invest smarter. They divide financial life into two major parts: the operational side, where you earn income, whether from a job or a business; the investment side, where you allocate your surplus earnings into assets that grow over time. Most of their podcast focuses on part 2, but Preston and Stig realized many listeners also need guidance on building the first part, creating online assets, businesses, or other ways to generate passive income. That's why they purchased the domain createpassiveincome.com, where they offer videos, tutorials, and courses on financial education, investing, podcasting, and more. One of those courses is a full chapter-by-chapter breakdown of The Intelligent Investor, created by Stig. With that, they wrap up the episode. thanking listeners and reminding everyone that Buffett's books offers free tutorials and tools for learning more about intrinsic value, stock analysis, and investing, as the episode closes. The hosts reflect on the entire journey through the intelligent investor and the lessons Benjamin Graham left. For generations of investors, they emphasize that while Graham's writing style may feel dense or old-fashioned, his insights remain timeless. The principles he teaches distinguishing investing from speculation, focusing on value rather than price, embracing rational analysis over emotion, and always demanding a margin of safety are concepts that continue to guide both new and experienced investors. Preston and Stig both acknowledge that Graham's books can be challenging reads, especially for those without a background in finance. Graham often used multiple terms to describe the same concept, and his explanations sometimes require slow, careful reading. But his philosophy forms the foundation upon which the greatest investors, like Warren Buffett and Charlie Munger, built their entire approach to wealth creation. They also restate that true investing is not a fast-paced or thrilling activity. It's grounded in patience, discipline, research, and emotional control. This is why Buffett always highlights chapters 8 and 20, understanding Mr. Market's emotional swings and applying the margin of safety principle are the keys to avoiding costly mistakes and achieving long-term success. The hosts then encourage listeners to revisit these ideas in their own investing journey. Whether someone is a defensive investor who prefers a simple, steady strategy, or an enterprising investor who actively searches for underpriced opportunities, the core of Graham's philosophy can guide them toward better decisions. Before signing off, Preston discusses the broader vision behind their work. He explains that investing is only one part of financial freedom. The other part involves building income, whether through entrepreneurship, online content creation, digital services, or other ventures. Many people listen to the podcast because they want to improve their financial life, but not all of them have a solid starting point for generating the money they later want to invest. This inspired Preston and Stig to expand their offerings beyond investing education by developing tutorials and courses under createpassiveincome.com. They aim to help people build online assets and income streams that can eventually fund long-term investments. These resources are designed to show people how to begin earning, whether by creating a podcast, building an online brand, developing skills, or forming a side business that grows over time. Stig's full chapter-by-chapter video breakdown of The Intelligent Investor is one example of these new resources. It allows readers to move through the book more easily, understand each chapter deeply, and apply the lessons directly to their own investing. Meanwhile, Preston is creating tutorials on how to start a podcast, covering everything from equipment to production to growing an audience. The episode concludes with gratitude for the listeners who join them each week. They thank everyone for their support and interest in learning about investing. They remind listeners that if they want to dig deeper into valuation techniques, intrinsic value, and analysis tools, all of that can be found for free on Buffett's books. These tutorials offer step-by-step guidance on using calculators, understanding cash flows, and applying the concepts discussed throughout the episode. As the outro music plays, they offer one final reminder. This podcast is for educational and entertainment purposes only. Any material from the show is copyrighted and requires written permission for commercial use. With that, they sign off, promising to return in the next episode with more insights, analysis, and practical investing knowledge. Thank you so much for watching. If you enjoyed this video and found value in it, make sure to hit the like button, subscribe to the channel, and turn on the notification bell so you never miss a new upload. Your support truly helps the channel grow and motivates me to bring even more high-quality content your way. Feel free to share your thoughts, questions, or suggestions in the comments. I always love hearing from you. Thanks again for being part of this journey. See you in the next video.